Hey everyone, this is Tom Savantry at Premier Trust Advisors. Thanks for joining me on this quick video. I'm just going to go through a basic example. There's a lot of misunderstandings as it relates to permanent life insurance, more specifically whole life insurance. And I just want to kind of walk you through a very basic example of some of the key characteristics and benefits of whole life insurance. And so a lot of it starts with the basic premise that there is a premium payment that goes into this. It's a contribution, I consider it, because a portion of it will be going to cover the costs related to the protection, the insurance component. However, there's a savings arm that is also built into a whole life policy, so that can build up savings. So in this situation, the premium, the amount going into the policy, is guaranteed. It never goes up. It is a flat rate amount and is guaranteed for the life of the policy. And within the policy, there is a buildup of cash value. That is, there's a guaranteed amount that grows over time, and it's a dollar amount, and it's set up within the contract, and you know exactly if you're putting this certain amount of premium in every month or every year, that's going to equate to a cash amount of cash value. And that's guaranteed, and it grows tax deferred. And so there's no taxes borne in there or paid during the life of the policy unless you surrender it, which we'll go into a little bit later. And so the third guarantee that's associated with the permanent or whole life insurance is the death benefit, and that would also be paid to the beneficiaries tax-free. So it's and it's going to be a sizable amount above what you're paying in your annual premiums, and it's a sizable leverage aspect of these policies that make them pretty attractive. We put a little money in, and you're protecting a significant value in terms of a tax-free death benefit. The fourth part about this is it's interesting is because we're using mutual insurance companies typically for these, is that because you are part of a mutual insurance company, you're part owner of that company. So you're eligible to receive, it's not guaranteed, but dividends. And that's created from the profitability of the company. And that is given to shareholders of the mutual insurance company. And those are assured people. So you have a policy with them. They're going to give you a portion of that every year on your anniversary, a dividend that when added to your cash value, create a new cash value. And that is now, once that gets added, never can go below that. Your cash value is set, a floor has been set. And through the course of a long period of time, that can equate historically been around 3.5% to 5% when you combine the guaranteed cash value that's in there and the dividend. So depending on rates and such, you may get up to 5%, but say especially in low interest environments like we live in today, it's probably closer to the 3.5%, maybe 4% range over time. But that's compounded tax-free, which is a huge benefit because if used properly, you'll never pay tax on the gain. Now, withdrawals, this is where people may have a misconception. You can withdraw the cash value in there. It's all tax-free up to the contribution amount. Certainly wouldn't advise doing that early in the policy as this thing kind of gets going. But down the line, you can take withdrawals out up to your contribution amount tax-free. It's all going in after tax, so stands to reason that you can get your contributions back tax-free. Now, there is a downside to that, though. That you may reduce some of your death benefit along the way, but you get access to your cash. The other way, especially as you've maybe taken out all the money that you've contributed, you can get a loan, right? There's a guaranteed loan provision that's in the contract with the whole life insurance contract and allows you to access up to 95%, some get a little higher, but 95% of your cash value in the form of a loan from the life insurance company. And it's guaranteed. There's nothing, they can't say no to it. It is, and you just have to call and ask for it. There's no credit check. There's no asking why you need it. You just get it. And the only terms of it are the percentage, the rate. And it can be variable or fixed depending on the company you go with. But you can pay that back on your terms. There's no payment plan per se. You can pay it back when you want. In certain circumstances, depending on where you are in the life of the policy and your age, you may never pay that back, because if you die with a loan outstanding, what ends up happening is the death benefit will pay for that loan, and the balance would go to the beneficiaries. So that spread will cover your loan, and so you won't have to kind of come out of pocket for that. Now, additional sort of aspect of this, which is not always included with a whole life policy, is this ability to add more money into the policy above your premium. Now, typically, the complaint about whole life insurance is there's not a lot of cash build up early. It does take some time, because obviously when you put a first premium dollar in, it's creating a massive risk for the insurance company that if you pass early, your $10,000 contribution will pay $1 million to your beneficiaries. So there is risk there for the insurance company. So they are investing the money and for the short run and trying to recoup their costs. So one way to add cash and build up cash faster is a concept, industry term called paid up additions. And so essentially what it is a cash infusion into these accounts that are buying smaller policies that are completely paid off. And so when you do this, when you're adding these PUAs or additional insurance, your death benefit will rise and your cash value will rise. So it's a way to, give an opportunity for people if they want to build up cash faster and certainly add some additional death benefit along the way, that it can build that up. And certainly when you're dealing with inflation and raising your death benefit can be a very helpful tool. And so all that's in a nutshell, but there's other benefits to this that I think also people don't appreciate. I mean, when you think about life insurance, you're not thinking about disability. Well, there is a ability for most policies where you can add a disability waiver premium to it, which basically indicates if you're disabled for a certain amount of time, that the life insurance company would pay your premium on your behalf, and you'd build up the cash value as if you were paying out of pocket. So it could be a very valuable tool, especially if you become disabled long term. Second bullet there is associated with creditors. This is a private account. So in most states, and it can vary by state, they are protected from creditors or lawsuits. And so those are added protections that you will not get in a bank account or investment account that you get here in a life insurance policy. Also, there are protections. Most of them come with chronic illness benefits and some semblance of long-term care benefits that you can utilize your death benefit while you're living in those cases. And there are riders or additions to the policy that can be added that really get closer to long-term care coverage. So using your death benefit as long-term care protection can actually protect your other assets from being drained if there's a need for long-term care. And then lastly, it's a pretty efficient tool to pass for legacy. It's tax-free, as I mentioned, and if done properly, if you are in the income level or net worth level, that may create estate taxes, there are ways to include life insurance into trusts that then bypass any estate tax considerations. So there are ways to pass this on very efficiently to the next generation, for charities, to family or whomever you want to pass the death benefit to. So I just want to, hopefully this was helpful. There are other aspects to it, but this gives you sort of hopefully a sense and an idea of the power of this tool. It isn't just insurance. There's a lot of aspects that can help, from protection to saving your money, as well as the ability to take loans and have flexibility for financing that could actually provide additional returns in other investments, or maybe deal with short-term emergencies, or even finance things like education or cars. So hopefully it's helpful, and this is kind of a tip of the iceberg, but certainly if you want to learn more about this, I would urge you to reach out. I have resources, online website to learn more, but just wanted to share this and hopefully give you a sense that it's a lot more than just buying a death benefit.